Let's go ahead and dive right in. First off, let me thank Reed and the guys over at Baby Pips for having me on the webinar today. The name of this training is called the Continuation Method. And we're going to talk about how to win 84.9% of your trades like clockwork, and that is even if you don't have any prior trading experience or you're not a Forex trader. What I'm going to focus on today is Forex. And so now perhaps the best part of this particular presentation is that the trading method that I'm going to show you today, the continuation method, is a trading method where you don't have a lot of stress or a lot of struggle. Most traders that I know don't want to spend hours and hours and hours in front of their computer analyzing the markets, reading charts, and you really don't want to have to deal with the wild emotional swings that occur when the markets don't necessarily behave the way that you'd like them to or the way that you thought they would. Now, how many of you want less stress and struggle in your trading lives? And I'm sure that's primarily everybody on here. Well, we're going to get rid of all of that today with just this simple method. And really my approach to the markets has been for over a decade to keep things very simple. And I'm going to teach you this by sharing how you can generate consistent returns of between 7 to 10% per month by using a very simple but secret technique that my hedge fund mentor taught me over a decade ago. Now, this one secret can completely rock your world, and I'm not kidding here, and change the way that you approach trading and get you results quicker than you might have thought possible. So make sure and have a pen and paper handy to take notes. Go ahead and turn off your cell phones, remove all the distractions around you. We've got an action-packed training today, and I will say, stay on until the end with me because I have a special template that I'm going to give you, as well as the actual ebook to this presentation, and a whole lot more, so that you'll have all of that handy and ready to go at your disposal. Now, let me share a quick disclaimer real quick. First of all rights are reserved to this presentation of these materials. The U.S. government requires that I share this disclaimer with you. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. Also, the CFTC requires that I let you know that hypothetical or simulated performance results have certain limitations, unlike actual performance, and that's pretty much a given. And then also, past performance is not indicative of future results. Now, let me give you just a brief introduction. I know Reed did a great job there, but let me give you a mercifully brief introduction here. My name is Cecil Robles. Over the last decade, I've coached and trained over 50,000 people how to successfully trade the Forex through various programs, courses, and trainings, just like the one that you're on today. Some of these systems include Advent Forex, Tokyo Trader, the Currency Signals Club, which has produced an ROI of 262.72% over the past 24 months. For our members. I'm also the author of How to Profit from the Falling Dollar, which has been an Amazon bestseller in the trading education category. There's a couple of shots of me and my family, including a pic of the newest guy there, my son Levi, and looks like he's destined to become the next Bill Gates there. I also have a couple of daughters, and we like to have fun. We like to travel. It's great that I can, spend a lot of time with my wife and my kids. And all thanks to what I'll be sharing with you here in just a moment, at least part of that. Now, that's also me with legendary investor and analyst Peter Schiff, who I met while presenting at the Las Vegas Money Conference. Now, the majority of the time, though, I work and I trade from my home in a pair of shorts and a T-shirt. And most summer afternoons, you can find me at my local golf club playing the game that I love. Any golfers here today? I'm sure there's a few on the call. It's one of those games that you can love and hate at the same time, and that's kind of how trading is as well sometimes. Now, over the past 10 years, I've developed and traded systems responsible for trading over 20 million in client funds and have been able to deliver above-average gains consistently. Now, as it relates to today's presentation, this includes the continuation method that I'll be showing you here today. So here's what you're going to learn on today's presentation, and allow me to be blunt, because you're not going to achieve trading success if you're not willing to call a spade a spade. Now, with that said, this webinar presentation is not like the majority of Forex fluff or hype that you'll find on the internet. when you actually apply the information that I'm going to share with you today, you're going to get more value out of this free webinar than you've probably gotten out of many of the books, products, and courses that you've actually paid for. And what's more, when you follow the simple strategy inside, you're going to be well on your way to making consistent Forex profits and actually winning as many as 7 out of 10 trades. The webinar is also going to be broken down into 3 different sections. The first one is Forex Basics. I know there may be some people on here that are Forex traders and you've been trading for quite some time. So this will be a review for you, but for others who have never traded Forex, I'm going to give you just a very brief introduction to Forex. Whether you're new to Forex or you have some trading experience under your belt, this section is going to help us lay a solid foundation. Section number 2 is called the continuation method. And this is the trading strategy that has really been one of my closely guarded secrets until now. And at the end, I'm going to give you a link to download a written version of this strategy along with a simple plug-and-play MT4 template to help you set your charts up just like mine that you'll see here in just a moment. And then Section 3 is a quick start checklist. All you have to do is follow the simple steps to implement this strategy that I've laid out in this quick start checklist. And whether you paper trade it first or you put real money on the line, you'll be able to get up and started very quickly. So let's go ahead and dive right in now to the presentation. Here's why all of what I've just said is particularly important to you in laying the right foundation and not really putting a whole lot of fluff behind this. We're going to get right into the nuts and bolts of it here. But you see, much of what you've learned today about how to succeed at trading, especially at Forex trading, because that's what I specialize in, is just flat out wrong. And this is the #1 reason why many traders are not experiencing the kind of results that they should be and that they deserve. Now, some of the bad information comes from what I call black hat marketers, and those are marketers who deliberately mislead you. You know, others don't give you the full picture, so you're left holding the bag. We've all run into that at some point or another, and I'm sure you've done the same thing. The numbers, however, do not lie, and numbers give us a wake-up call. Brokerage data actually shows us that on average, over 60% of the retail trading accounts out there lose money, and at FXCM, one of the largest Forex brokers in the U.S., over 70% lose money. Now, to a large degree, much of this has to do with the amount of hype that there is to sift through to actually find something good. You know, all you have to do is do a Google search, and you'll see that there are all kinds of courses and books on how to trade the markets. In fact, trading education has become a multi-billion-dollar industry in and of itself. Now, unfortunately, with that kind of money flying around, there are bound to be some bad eggs out there who really don't have your best interest at hand. Now, what's more, most regular traders are caught between two worlds. On the one hand, you can't afford to waste any more of your precious trading capital and your time on a hyped-up system that costs $1 or $2 grand and then ends up draining your trading account dry. On the other hand, you may not have the necessary capital to invest in the types of systems used by the big currency funds or big trading funds that actually produce results and that see above average returns on a consistent basis. And for all of you on this webinar, your timetable to start building retirement wealth is actually right now. Now, I say that because regardless of your present age, you can look ahead 5 to 10 years and realize that you can't afford to make trading or investing mistakes between now and then, not if you want to retire rich or at least retire comfortably. And when you factor in all that's going on in the U.S. and global economies, the time to start really building long-term wealth is now. So that's why it's really important that you pay attention to all of this. Section #1, let's dive right into some Forex basics. Now, in case you're wondering, Forex stands for the foreign exchange market. It's just short for that. Now, although it doesn't get as much media attention as the other stock and bond markets, although it has here recently, the Forex is actually the largest financial market in the world. There are over 5 trillion in transactions that occur every single day. And on the simplest level, the Forex market is the market in which currencies are traded. Now, when you trade the Forex, you're essentially buying and selling money, money from all over the world. The currency market used to be only the playground of the central banks, the large institutional banks, the hedge funds, international companies with a lot of money. But this all began to change in the early 2000s due, of course, to the widespread access to the Internet. Now the average investor today can gain access to this incredibly exciting market 24 hours a day, 5.5 days a week, and all you need is a computer and internet access. Now, if you've ever traveled to another country and you exchange your home currency for that of the place where you were visiting, then you've already participated essentially in the Forex market. What we do is we trade the spot Forex market, which is the cash market. So compared to the stock market, currency pairs don't move as much. In fact, on average, most currencies fluctuate less than 1% per day. And this may not sound very exciting, but a 1% movement can equate to 100 or more pips. Now, a pip is similar to a tick or a point in the stock market. So I'm just trying to give you some lingo in case you're not familiar with the Forex market. You can be up to speed when I start getting into the continuation method. In other words, what you can do is you can simply make some serious money banking on these small movements. And here's where it gets really exciting. See, trading the Forex requires most traders to use leverage or margin. Now, to increase this allows them to increase their potential return for small moves in the exchange rate. For instance, if you live in the U.S., you can trade with as high as 50-to-1 leverage. Traders who live outside the U.S. can use as much as 500-to-1 leverage, and even higher with some brokerages. Now, this is not really suggested, but to give you an example here, to trade $100,000 worth of currency with a broker that requires 2% margin, you'd only need $2,000 deposited into your account, giving you leverage of 50-to-1. Now, this is not really as risky as it sounds, and here's why. Because currencies don't fluctuate as much as stocks. The currency market rarely gap stops, although sometimes it does. We saw that happen recently with the dollar Swiss franc, and the key there is not to trade markets that are being manipulated, just like you wouldn't trade a stock or you wouldn't trade a commodity or a futures market that is trying to be cornered or trying to be manipulated. I'm going to show you how you can also cut your losses quickly and let your profits ride in this particular methodology and presentation that I'm going to give. So when you place a position to buy a currency, 9 times out of 10, you're going to get your position filled at that exact price. And also, unlike the stock market, there's no central market location. Trades are actually conducted through a lot of individual dealers or financial centers. And here's just 10 brief reasons why you should at least consider trading the Forex if you're not already doing it. First of all, there is non-correlated price movement. So for the most part, currency pairs are uncorrelated to the stock market, and this means that if you're a stock trader who is losing in the stock market or who is maybe short or who is long in the stock market, you can benefit from fluctuating currency prices that are completely uncorrelated. There's fewer rules, unlike trading the stocks or the futures or the options. Currency trading does not take place on an exchange with rules like the New York Stock Exchange or the CME. In fact, if you had exclusive information and it was used to make a lot of money, legal issues would not arise as they would in other markets. Now, it's hard to come by that information, obviously, but once again, there are fewer rules. There's no to low commission. Just depending on how you set your trading account up, you can actually trade with no commission, or you can trade with very low commission when you trade the Forex market. It's a 24-hour market, so it doesn't matter where you live or which time best suits you to trade. If you have a day job and you like to trade in the afternoons or the evenings, you can do that because there's always a market where there's some action going on. And if you're a night out or you live outside of the U.S., you can obviously trade during the middle of the night if you'd like to. Now, there's also less market manipulation, although there is still market manipulation by the central banks, but that information is readily available when the central banks do stuff to manipulate the market. For instance, recently with the dollar Swiss franc, the Swiss franc currency in many of its cross pairs, also the Swiss have been manipulating the market since 2011, where the central bank set a ceiling of where the Swiss franc could trade in regards to the euro and in regards to the U.S. dollar. And they've been manipulating the market. So the key there is not to trade markets that are manipulated. And that's very easy to come by that information. You can also buy and sell with ease. Unlike the stock market, there's no uptick rule in Forex, and this means that you can sell just as easily as you can buy. There's some great tax benefits. I won't get into a whole lot of that right now. but when you trade Forex, 60% of your gains, and this is if you're in the U.S., are taxed as capital gains, and the remaining 40% are taxed as regular income tax. It's historically a trending market, and from my perspective, you know, the trends are where the money is made, and there's a lot of big trends that take place in the Forex market every single year. It's a technical trader's dream for those of you that like technical analysis. It's very easy to work technical analysis in currencies. So this allows short-term traders to pull quick and precise profits from the market, and long-term trend followers to profit along the way of the big trends. And there's also a very low barrier of entry. You can start with a very little amount of capital. Now let's dive right into the continuation method trading strategy, as we have about 30 minutes left here in the presentation. I want to spend as much time as possible going through this method and really get it in your brain here so that you can use it to really make some money in the markets. So the continuation method is a trend following technique that essentially works across all markets. So using this method gives you a very good chance of winning from 60 to 70% of the time, and even up to 84, 85% of the time, as we've seen in some of the markets that we've traded. Now, trend following is really a scientific and a mechanical way to approach trading that removes most of the guesswork, and it has a very strong history of performance during crisis periods and is at the core of most of my trading methods. Now, the idea behind the continuation method is to wait for a setback in the market and then jump in the direction of the trend. So just to give you a quick example here, let's say the market has moved up and it's moved down, and now we have a breakout period, and the market finally breaks out and gives us a trend. Well, right here in this red zone here, this is what we would call a pullback in the market. And then what we're looking for here in this red zone is for the market to continue up. We have a very limited amount of risk here and a very high upside potential. Now, we're using only technical analysis, and that means that we're going to be looking at price charts for different currency pairs to make our decision. Now, you can trade this method using long-term, medium-term, or short-term type of analysis, and so we're going to get into all three of those here as we go through this methodology. Let's look at, first of all, the tools that you're going to use. We use indicators simply for just giving us some very basic setup parameters, but really what we're doing is we're following price action for the most part. So the first thing that we're going to put on our chart is what we call the percent R, or the Williams percent R, and it was developed by Larry Williams, and it's a technical analysis oscillator showing the current closing price in relation to the high and low of the past N days for a given N. Now, its purpose is to tell whether a commodity or a currency market is trading near the high or the low, or somewhere in between of its recent trading range. Now, we're also going to use this in combination with a simple trend finding technique to determine the best possible entry during a during a correction in the trend. Now, the second thing that we're going to put on our chart here is a 50 exponential moving average, and an EMA is simply a type of infinite impulse response filter that applies weighting factors which decrease exponentially, and the weighting for each older datum decreases exponentially, never reaching zero. And what this does is it helps us to measure a trend by taking all previous data into account, at least for the past 50 bars. The 5 simple moving average is the last thing that we're going to use on our chart, and this is just simply a very simple moving average that we use to actually determine where we're going to exit the market based on a trailing stop. So we allow price to tell us where to get out the majority of the times. Now, these indicators can be found pretty much on every charting software program out there. We prefer MetaTrader 4 or NinjaTrader, and the MetaTrader 4 is absolutely free. NinjaTrader has a small monthly cost just depending on the brokerage firm that you're using it for. If you're using a broker that you can connect the data into, then there's no monthly cost at all. Now, this is the way that your chart should look. They should look very clean with these indicators on there. Here's a screenshot showing how the chart looks with each of these indicators in place. You have the 5 simple moving average up here where the orange line is. You have the red exponential moving average, the 50 exponential moving average, which is the red line. And then you have the Williams %R down here with a negative 20 at the top and a negative 80 for our filters there. Now, the parameters are very simple for the 50 exponential moving average. And like I said, I'm going to give you a template where you'll be able to just simply plug and play these right into your chart with the template that I give you with MetaTrader 4. But this is the way that it should look. We're applying it to an exponential moving average method. We also apply it with a typical price. That means the high, low, and the close divided by 3. And we use a red style on our chart. Very simple. The 5 simple moving average, we use an orange style on our chart. It's the simple moving average method, and it's applied to the close price. And then the Williams %R, once again, very standard here. We're using just the 14 period, and once again, we have the levels set up at negative 20 and negative 80. Now let's dive right into our rules of engagement. It's time to start learning how to use this simple system and look at several examples here before my time is up. So with this method, you have the option of trading in multiple time frames. Here is a breakdown for how to use the different time frames. First of all, we can trade end of day. That means that we're going to look at the charts one time a day at the end of each day, and we're going to be in trades for 4 to 30 days, just depending on how big the trend is. We might be in trades up to a month long if we're in a really good trend, and that's where we can make some really serious money when we get into a trend like that. Charts to use, the weekly and daily charts. We confirm the trend on the weekly chart and we trade the daily chart. Swing trading, this simply means that you will look at the charts a few times a day and you're going to be in trades from 1 to 4 days. The charts that we use here are the daily and the 4-hour charts. We confirm the trend on the daily and trade the 4-hour chart. And that's a mistake there in the slide, but we trade the 4-hour chart when we're swing trading. And then intraday trading, this means that we will look at the chart several times a day and we'll be in trades from 1 to 2 days. And the charts that we use are the daily and the hourly charts. We confirm the trend on the daily and trade the 1-hour chart. So it's really simple. If you're doing end-of-day trading, then you'll be using the weekly and daily chart. And the first thing that you want to do is you want to find the trend on the higher time frame. In this case, in this example, we're looking at the weekly chart. Now, the way that you do this is very simple. You look at the 50 EMA and count back 10 bars and determine whether or not it was sloping up more over the last 10 bars or if it was sloping down more over the last 10 bars. So if the 50 EMA was sloping up, then the trend is up. If it's sloping down, then the trend is down. It's pretty simple. If the trend is up, you can only take buy trades, and if the trend is down, you can only take sell trades. So here is a look on the pound-dollar weekly chart. You can see that the EMA, the red line on the chart, begins to change at bar 1 by beginning to slope up. Here's where the slope begins to change up here, and it continues to slope up for 10 bars. So we can see over the last 10 bars that that slope is now up. If we go to the daily chart during this particular period of time, we'll see that this trend has started off fairly strong on the daily chart by now. Now all we're doing is we're looking at pullbacks and we're looking to trade in the direction of that trend. It's very simple. So here we can see that's where the trend line changed up on the daily chart, and here's where we had our first pullback. Now a pullback is identified by any time a candle closes on the opposite side of the 50 EMA against the trend. So here's where we had that first occurrence. This candle closed below the 50 EMA line on the daily chart. Now the first thing that you want to verify is the trend on the daily chart is the same as the trend on the weekly chart. And we can see that the trend is the same. The line is sloping up just like it is on the weekly chart. The next thing that we want to do is we want to look for a pullback against that trend. And the way we identify it is very simple. Once again, if a candle closes below the 50 EMA while the trend is up, then this is considered a pullback against the trend. If a candle closes above the 50 EMA while the trend is down, then this is considered a pullback against the trend. So you can see here, once again, trend is up. In line with the weekly chart, we had a pullback against the trend here, and you can see that we have an opportunity potentially to buy. And that leads me to rule number 3. we want to verify where the Williams percent R is in relation to the negative 80 level or the negative 20 level. Since we're looking to buy here because the trend is up, we're going to look to see where the Williams percent R is in relation to the negative 80 level. And so in this current example here, you can see an uptrend, and you are looking to buy the market. So we're going to be looking at the Williams percentage range to go below the negative 80 level. Once it goes below the negative 80 level, you're now looking for it to rise back above the negative 80 level. So the bar that corresponds with the rise of the Williams percent R back above the negative 80 level will be our signal candle. So you would place a buy stop above the high of the signal candle or below the low for a sell. And the stop loss is going to go below the low of the closest swing point in the opposite direction. So you can see here, I've placed a buy corresponding with the candle where the negative 80, where the Williams percent R went back above the negative 80. Here's the negative 80 line. It's that dotted line on the chart. And then it went back above. That's the candle it corresponds with, and I'm placing a buy above that high and a stop loss below this low here. And you can see that this example actually turns into a loss. I wanted to show you a loss right from the get-go. But then we have actually another setup, and you can see that setup occur right here where we went back below the negative 80 level. Our line is still sloping up. It's in the direction of the weekly chart as well. And then price broke back above that negative 80 level, and here's that example continued. So we had a losing trade here, and you can see here we have a 5-step process. Number one, we see if the trend is up. It is. We have a pullback. We have a candle close below the 50 EMA. The Williams percent R then goes below the negative 80 level, as you can see here. The entry is made above the high of the signal candle, where the Williams percent R goes back above the negative 80 level, which corresponds with this green candle right here. And then you can see here that we had the stop loss placed below the lowest swing point, which is this swing point right here. The entry is placed above the high of that candle because we're looking for a breakout above that high. And sure enough, price breaks out. And you can see here that it goes and goes and goes until finally we get stopped out right here with a trailing stop. And I'll explain the trailing stop and the profit-taking rule here next. So let's look at the profit-taking strategy. Here's how it breaks down. Let's say in this particular case our entry was 60.77.3, 1.60773 on the US, on the Great British Pound US dollar. Our stop was at 1.58439. That's a difference of 223 pips. Remember, we're doing end-of-day trading, so we only have to look at this one time a day. Each of these bars is representative of 1 day's worth of data. So price has to reach 1.65430 in order to move our stop using the trailing stop method. And that's because before we consider putting a trailing stop in place, we need to have a 2-to-1 reward to risk ratio. So if we have a 233 pip stop loss in this example, that means that price must move 466 pips in our favor before we can move our stop loss. And here's how the breakdown works. Once again, right here, we get the difference in pips, then we change for our take profit point, which is a 2-to-1, and then we can either take profit at that point or we can use a trailing stop. In this example, 466 pips is quite a ways. We probably take profits at that level, but to give you an example of how this trailing stop works, let's go ahead and look at this example here. The way that we're going to trail this stop is with this orange line right here, the 5 simple moving average. So here in this case, we can see that the green line up here is where price reaches a 2-to-1. That means it hit 466 pips approximately right here in this area. We could either take our profit here. That means that if we risk 1% or 2% on this trade, we would make a total of either 2% or 4% of profit. That means that if we had, for instance, let's say $1,000 on the line here, let's say we were trading a $100,000 account and we wanted to risk 1%, we would make $2,000. If we wanted to risk 2%, which would be a $2,000 risk, we would make $4,000 on this particular trade. So in this particular example, you can see here that once we reach that level, what we're looking for is we're looking for 2 closes below our 5 simple moving average. We get that right here. 1, 2 closes, we move our stop loss to below the lowest of the two, which we trail the stop here. In this case, it would have been about a 1.16 reward to risk ratio. That means for every $100 we risk on the trade, we make back $116. All right? So this is an example of an end-of-day trading strategy, which if you have more money on the line, you're going to want to trade probably an end-of-day trading strategy. If you have less time, you're going to want to trade an end-of-day trading strategy. Let me give you another example here. And in this particular example, you can see here, once again, we want to know, is the trend up? It is. We can see here that the trend is sloping up. We'll assume that the trend is up on the weekly chart in this example as well. We have a pullback against the 50 EMA. You can see here, price goes and it closes below the 50 exponential moving average. The Williams %R goes below the -80, then back above. You can see right here in this zone that I have highlighted blue. So we go below the 50 exponential moving average. The Williams %R goes below the -80 level in this case. And then it comes back above. Our entry is here. Our stop loss is below the lowest swing point right there. And our entry is made above the high. Stop loss is made below the low. And you can see here, this is where we reached a 2-to-1 reward to risk ratio in this particular trade. You can see then that we had 1, 2 closes below the 5 simple moving average. We would trail our stop at that point, and then price continues up. Now, generally, if we get double a 2-to-1 reward to risk ratio, like a 4-to-1 reward to risk ratio, which we would have gotten in this particular case, we'd probably end up taking our profits there. That means for every $1 that we risked, we made $4 back. For every $100, we made $400. For every $1,000, we made $4,000, and so on and so forth. And you can see here that if we would have trailed our stop, you can see that we had 1, 2 closes below the 5 simple moving average, and we would move our stop loss to below the low of the two, the low of the lowest of the two here, rather. And you can see that that is represented there by that green dotted line. That's where we would trail our stop, and we would eventually get stopped out and take our profits at pretty close to a 2-to-1, a little bit over a 2-to-1 in this particular example. Let's look at another example here. In this particular case, I want to show you how we can be in 2 trades at the same time and actually double our potential. We do double our risk, of course, but nevertheless. I also want to show you another example here where we did not quite get below the 50 exponential moving average, and that would have been an invalidated trade, although the trend was up, although the Williams %R went below the -80 level. You can see here that we did not actually go below the 50 exponential moving average, so we would not have taken that particular trade. Now, here we have price going below the 50 exponential moving average. We want to go through our rules of engagement here. Number 1 is the trend up. Number 2, do we have a pullback candle that closed below the 50 exponential moving average? Since the trend is up, we're looking for a close below. Did the Williams %R go below the -80 level, then back above? And in this particular case, in this example, it did. So we would place our entry point above the candle corresponding where the Williams %R went back above the -80 level, right here in this candle. We place the entry point, we place the stop loss. Then you can see here that we had another dip back below the 50 exponential moving average. Actually, price never went back above or closed back above. We had another dip back below the Williams %R, just barely. It went back below that -80 level, and this sets up another potential entry for us. Right here, this candle corresponds where price went back above the -80 level, and we can place another entry above this high with a stop loss below the closest swing, which would be here, or we could put it back below this right here and make our stops the same. And in this particular example, we now have the second entry that gets triggered right here, rather on this next candle right here, and we're in this particular market, and you can see that price comes up. We eventually get a 2-to-1 reward to risk ratio, and then we're able to trail our stop using our 5 simple moving average. We have 1, 2 closes below the 5 simple moving average. We move our stop, and we get out of the market roughly with a 2-to-1 reward to risk ratio in this particular example. But now we have 2 trades on versus 1, so you can actually trade multiple trades here. All right, let me go ahead and move on to another example. This is an example actually using a swing trading using the 4-hour chart, the daily chart and the 4-hour chart. This is the pound dollar 4-hour chart. During this same time period, except we're trading the 4-hour chart, which actually gives us more trading opportunities, but we use the same exact rules. Number one, we want to make sure that the trend is in line with the daily chart. In this case, it's sloping up, and it is. We have a pullback here. We have a price close just barely below that 50 exponential moving average, and then it comes back above here. We can see that we have an entry with our stop loss. The Williams percentage range went below, then came back above. That gives us an entry period. And in this case, we hit our initial 2-to-1 reward to risk ratio. And by using our trailing stop, we're actually able to get 4.3 times what we risked. That means for every $100 that we made, $430, and that's not too bad there. And you can see here that we had 1, 2 closes below our 5 simple moving average. We would move our stop loss, trail it up. In this particular case here, you can see that we would eventually get stopped out. Now, there are some other trailing stop techniques that I get into in the report that you'll actually get at the end of this particular presentation. I'm not going to go into those right now, but essentially you can trade this as a swing trader as well. Now let's dive into the position sizing. Position sizing, we can do one of two things. We can either use fixed fractional position sizing, which means that we're going to be risking a percentage of our account on every single trade. I like this particular position sizing methodology. It is a little more complicated to figure it out on each trade, especially if you're trading an intraday strategy where you need to be able to execute the trade quickly. We have another methodology. But let's say that your account balance is $10,000. Your dollar risk on each trade would be, let's say, 1% or $100. That means that you're risking 1% on every single trade. So if you started with $10,000, you're going to stick with $100 risk or more as your account grows and increases in size. Let's say that your pip risk was 100 pips. That means that you were entering the market at, say, 1.4500, and your stop loss would be at 1.4400. You would have a 100 pip stop loss. So in this particular case, all we do is we take our dollar risk, we divide it by our pip risk, and that actually gives us the equivalent of what we should trade in our position size. In this case, if we risk $100 and we have a 100 pip risk, it equates to 1. In other words, we're wanting to risk $1 per pip, which means that we would trade roughly 1 mini lot depending on the currency pair that we were trading. There is a simpler way to do the position sizing, and that is by simply risking 0.01 lots per $1,000 in your account on every single trade. So that's 0.01 lots in your account on every single trade per $1,000 you have. So if you have $10,000, you'd risk 0.1 lots. If you have $100,000, you'd risk 1 full standard size lot. Now I go into a lot more detail in the report as well, so you can avail yourself to that. Let me just give you a quick start checklist. I know my time is running up here. We've got a few minutes left, and then I'll answer a couple of questions if I can. Step 1, you want to choose a broker. In the report, I go through how to choose a broker depending on which country you're in. Step 2, you want to pick your trading platform. I go through that as well in the report. And then step 3, you want to look for these simple trade setups using these 4 simple techniques. Number 1, identify the trend on the higher time frame. Number 2, move down 1 to 2 time frames and look for a pullback against the larger trend. So if you're trading end of day, you're going to trade the weekly and the daily. If you're trading the daily, if you're doing swing trading, you're going to trade the daily and the 4-hour. If you're trading intraday, you're going to trade the daily and the 1 hour. Then you want to verify the Williams %R is at the -20 level for selling or the -80 level for buying. And then number 4, you want to enter the trade using no more than 1% risk, and you want to follow the profit-taking rules. It's really that simple. So let me give you the download for the continuation method here, and then I'll go into some question and answer, as I know, once again, like I said, I just have a couple of minutes left. So you can get the report here at www.yourforexmentor.com/continuation. All you have to do is just enter your email in there. You'll get an immediate download of the report. I think it's something around 30 pages, and it has all of this information in there as well as a whole lot more. Plus, it has the templates that I told you about. So you'll be able to have this at your fingertips. You'll be able to go through, and then you can also, once again, paper trade this methodology for as long as you like to prove it. I've actually been using this now for over 10 years. It's one of the core methods that I use. I've still been using it regardless of what the market does, how the market changes or shifts. This method works over and over and over and over again, and it's not fluff or hype. I've actually put it into practice, and like I said, it's actually one of the core methods that I use, and I teach my students, and I also use when we trade funds and when we trade using our signals as well. So if you can go ahead and pop that link up there, Reed, I'm not sure how to do that, but I'm sure you can put that link up there. And I'm going to go ahead and take a moment and answer some questions. So let's go ahead and answer some questions here while I have the next 60 seconds or so, and then I'll make sure that I stick around and actually type in the questions. So in my report there, one of the questions is about the brokers. In my report there, I give a brief explanation of how to choose a broker, as well as the governmental regulating bodies for each country depending on where you're at. Forex is a 24/7 market. Where do you consider which closing point? Well, I shared the profit-taking methodology with you. You can also just set a hard take profit in there, especially if you're doing intraday trading. There's some other methodologies that I get into in the report for taking profits and for setting an actual hard take profit. A lot of questions about Forex brokers, but once again, you can go into the report and you can avail yourself to what I show you on that. On to determine the slope, you said to find 10 bars. Will it not be late on the 1 hour time frame? You're not using the 1 hour time frame to determine the trend. You're simply using the 1 hour time frame to actually place the order. You're going to use the daily time frame, even the 4 hour time frame to determine the trend, and then you're going to jump down to the 1 hour and wait for a pullback against that trend, meaning that you'll get many more pullbacks on the 1 hour time frame against the trend of the daily chart or the 4 hour chart than you would on each of those time frames, and that's the purpose of going down a time frame. What time frame are you applying the Williams percentage to? You're applying it to the time frame that you are actually placing the trade on. So if you're trading the end of day, you're placing it on the daily chart. If you're trading a swing trading, you're placing it on the 4 hour chart. If you're trading an intraday, you're placing it on the 1 hour chart.